Hello and welcome to IG's Trading the Markets podcast. I'm Victoria Scholar, and this week we're discussing the oil market with Gaurav Sharma, the oilholic, and he's a contributor for Forbes as well. Now, prices have slumped by about 60% since the peak in January, and while OPEC Plus has tried to push up prices by cutting production, the sharp drop in demand because of COVID-19 appears to be outweighing the reduction in supply. Gaurav, great to talk to you. Now, I wanted to start with some comments that we had from the International Energy Agency out this morning, saying that global oil demand is likely to fall by a record amount in 2020. What did you make of the report? Were there any bits that stood out to you?
Good to be back on the program, Victoria. It's nice discussing the market, although the market itself is not in a nice phase at all. Now, my last interaction with Dr. Bureau was at International Petroleum Week in February, and he said at the time that he was very concerned about the demand, that the IEA would revise its stance fairly swiftly. At the time, the IEA was saying that the whole year, the demand for the whole year as a whole would probably suffer only in the second quarter. Now, they've come out with some stats, and I think they're pretty alarming. So if you're talking about a near-term loss of 29 million barrels per day, that's a substantial figure. But the IEA is also saying that while the next couple of quarters is going to be very tough for the industry, there is light at the end of the tunnel. At least that's what my reading is of the tea leaves, the IEA tea leaves, is that they're forecasting that towards the end of the year, should the global community get a handle on the coronavirus, the COVID-19 pandemic, we could see a return to positive sentiment towards the first quarter of 2021.
We heard from, obviously, OPEC Plus, including Russia, which agreed to cut its output by 9.7 million barrels a day in May and June, which is about 10% of global supply. When we're faced with this major slump in demand, do these production cuts really make a difference?
Great question. I think what we're looking at right now is now purely a demand side crisis. The oversupply issue has been kind of addressed by OPEC++. Now, there's certain caveats here. First is, do we take what these oil producers have said at face value? All right, 9.7 million barrels per day, big cut. You can perhaps throw in another 1.5 million from, at least that's what's been promised by elsewhere within the G20. Even if we take all of that at face value, that still only comes to a third of the least pessimistic demand decline forecast that we're noticing right now. Now, that's the first thing. Even if the cuts are taken at face value, it still doesn't address the sort of oversupply we'll see over the course of the second quarter. Secondly, can we really take it at face value? Now, much of that cut is predicated on the Russians cutting 2.5 million barrels per day. Now, this is the same Russia that throughout 2019, I beg your pardon, has almost singularly failed to meet its OPEC Plus promises. It only did that in the couple of months that it faced a pipeline outage. So what we're looking at here is that the market is saying, well, all right, well, you put a headline number, but that isn't really a very pleasing headline because all of us are going out less, we're driving less, the airlines are grounded, consumption is low. And yesterday, the IMF put a very dire outlook, at least a very dire near-term outlook on the global economy.
Obviously, Russia said that it's wanted the G20's involvement when it comes to production cuts. We've heard from Norway's energy minister saying that it's going to decide on whether to cut crude output soon. Are you expecting something from them this week?
It's the age-old tussle between the consumers and the producers within the G20. I took note of Norway's comments. But there's another comment that we heard over the course of the Easter weekend, which is by the Indian oil minister. Now, India is the world's third largest oil exporter. Like the rest of us, a country of 1.3 billion is in a lockdown, or at least as close as you can come to a lockdown for a country or population that size. And the Indian minister said that he doesn't necessarily mind low oil prices. Because right now, while Indian demand is sort of flat, what the Indians are trying to do, and so are the Chinese, is to stock up their strategic petroleum reserves. And for an economy like India, they don't necessarily mind $20 oil prices. So if you think that 20 or the likes of Turkey, etc., are speaking in one voice with the likes of the Saudis, then that's a fallacy. I don't think that is correct. So So G20 played lip service because it was such a dire situation for the oil and gas business. But overall, I'm not reading too much into G20 cooperation. In fact, when the data aggregators, the Platts and the Arguses of this world come up with what has actually been cut or complied with, or as the United Arab Emirates said, oh, we'll overcomply. Let's see what the data says, because right now, I think April is pretty much a write-off, in my humble opinion. Around about till the middle of May, we'll see some sort of traction. Like, for instance, President Macron has said he'll have a phased lifting of the lockdown around about the 11th of May. Something similar might be expected in England, in Austria, and so it goes. But there won't be a return to normalcy. Things won't come back to normal in a snap, and consumption would remain low, especially in OECD markets where it has already historically been quite low. So I take what G20 and a lot of these ministers are saying with a pinch of salt. They might do their bit, but the consumer is not in a good mood to, quite frankly, consume.
So just on a slightly separate note, a bit of a technical question. I mean, we've seen that the oil market has gone heavily into contango, which is where futures prices are sharply above spot. What's happening there? Why is it in this kind of phase rather than being in backwardation? And what's happening with storage costs?
I think what's happening here, Victoria, is that everybody wants to do a gun war. Back in 08, 09, the commodity trading house made millions by just playing the market right. Historically, we saw the oil price overshoot to about $147 just before the financial crisis happened, and then it plummeted to 30. That was a huge differential. What we are noticing right now is that even if the oversupply crisis has somewhat been addressed, the demand crisis is a very tough one to call. So the play here is, and we're seeing, I think a fortnight ago, the contango was somewhere in the region of about $14, which is a substantial gap. So we're looking at all these players attempting onshore storage, floating storage. We heard all those stories on the wires about crazy prices for oil tankers. In one instance, somebody had even paid $400,000 a day to lease a VLCC, a very large tanker. Now, I doubt that the kind of profits the contango enthusiasts made back in 08, 09 would be replicated this time, because we're fighting contango at a much reduced level. Second thing is, much of it is predicated on things, and they might well do. Much of it is predicated on things returning back to normal, or some sort of normalcy, maybe around August or September, and then gradually improve from there on. So the punters are betting, the big commodity trading houses are betting that if they can have enough barrels, whether it's floating or onshore storage, they'll make a buck or two or more than that. Now, the problem here is that, for instance, a lot of forecasters are saying, well, this crude that's coming out, it has to be stacked up somewhere. These barrels have to be stacked up. The issue here is a lot of onshore storage would be full to the brim in April, early May. Now, whomsoever you rely on, whether you're looking at IHS Markit, Standard Chartered, Goldman Sachs, any of the aggregators, you get forecasts somewhere between end of April to around about the middle to late of May, where the world might well effectively run out of storage space. And then we have a real issue. Floating storage will not quite cut it. And these contango plays, while they will materialize, the profits won't be where they were in 08, 09. In fact, what might happen is, at that point in time, if we are still in negative sentiment, if the macroeconomic headwinds are still there, we could see back a return of a nominal backwardation. But right now, I think contango plays are where they are. You'll see a $10 plus contango gap between now and the November and December contract, using Brent as a benchmark. But that's where we are. I think a lot of people are betting on some sort of a reversal in market sentiment, and they may not be wrong. They're betting in some sort of reversal market sentiment around about August.
What are you expecting to prices? I mean, if we take US crude, for example, we fell below $20 today for the first time, or the lowest level, I should say, since 2002. I mean, these are absolutely unthinkable levels if we were to be talking about prices back in January when it was trading in the mid-60s. How much lower could we go?
I think you and your colleagues would testify that I have been bearish for quite a while, but this is an unprecedented situation. what we have is, and I think we keep overusing this word unprecedented. You must have heard it quite a few times over the last 3 weeks, I suspect. From where I sit, Brent and indeed West Texas, there are historic lows. In West Texas case, we're down to 2002 lows. And the issue is that there is an awful lot of US crude that has nowhere to go. Now, I based on sort of my reading of the situation or my personal sentiment, I think what I see is that it's going to get a lot worse. April is going to be pretty bad. We could hit mid-teens, mid to lower teens. And then I think there'll be a correction mechanism based on the kind of sound bites coming out of Washington, coming out of Paris, coming out of London, in terms of, and especially coming out of the consumers, i.e. New Delhi, Tokyo, and Beijing, as to where this is going. But April is going to be pretty dire. May is going to see another phase of reduced prices. Now, the classic problem here of those trying to predict the market, especially if you look at spread bettors, smart money was that over the Easter break, should this deal materialize, and it more or less materialized, 10 million BPD was promised, we got 9.7 million. It's practically the same, excluding some barrels from Mexico. Now, the smart money would have been that you bet the price up. But the problem here is that if the demand is not there, then no matter how big the cut is, it will not address the gap. And that is the problem OPEC is facing. It's fired its bazooka, and now it's got no more ammunition left. It's kind of like all of us do not want to go out to eat in a restaurant, but the local restaurant keeps discounting. But if you're not in a mood to go in, then that discount doesn't matter. And that is OPEC's problem. It's fired we remember Hank Paulson's bazooka at the time of the financial crisis. People say it only got results. I don't, and the OPEC is having the same problem. It's fired its bazooka, but it's going to get very mixed results. And over the short term, it's going to get very poor results.
All right, Gaurav, thank you so much for your time.
Thank you for having me.
Yeah, that's all we have time for today. Thank you so much to my guest, the oilaholic Gaurav Sharma, who's a contributor for Forbes. I'm Victoria Scholar, and don't forget to subscribe to our podcast, IG Trading the Market.